Welcome to the Markets Mindset. Today we're diving deep into one of the most important aspects of trading that separates amateurs from professionals: risk and psychology. If you've been trading for a while, you'll know that charts, strategies, and indicators only make up a small part of the game. The real challenge, the thing that makes or breaks traders, is how you handle risk and how you manage your own mind. This is where success or failure is decided. And in this video, we're going to explore the principles, the pitfalls, and the practical tools that will help you take control of your trading psychology and risk management. Let's start with a simple truth. Every trade you take is uncertain. No matter how strong the setup looks, no matter how confident you feel, there is always a chance that it fails. And that uncertainty is not a flaw of trading. It is what trading is all about. The sooner you accept this, the sooner you'll start making decisions based on probability instead of emotion. Risk is the price of participation. Without it, there is no reward. But here's the paradox. Most traders spend far more energy chasing the reward than respecting the risk. They dream about the big wins, the account-flipping trades, the moment they finally make it, and in chasing those dreams, they ignore the fact that if you blow up your account, you're out of the game entirely. Survival always comes before growth, and that's why risk management is the foundation. Think about it like this. A professional poker player doesn't sit down at the table expecting to win every hand. They know they'll lose plenty, but they also know the math. They manage their stack, and they play the long game. Trading is the same. You are not trying to win every trade. You're trying to stay in the game long enough for your edge to play out over time. So how do we define risk in practical terms? First, there's account risk. How much of your account are you willing to lose in a single trade? Most professional traders risk between 0.5% and 2% per trade. That might not sound exciting, but the math tells the story. Risking small allows you to survive losing streaks. Risking big almost guarantees that a few bad trades will wipe you out. The amateur thinks about how much they could make. The professional thinks about how much they could lose. Then, there's position sizing. This is where many traders trip up. They know their stop-loss level, but they don't size the trade correctly. Position sizing is the bridge between your account size, your stop distance, and your risk per trade. Get it wrong, and you're either risking too much or wasting opportunities. Get it right, and your trading becomes consistent and scalable. Now let's talk psychology, because this is where risk truly collides with reality. You can know the rules, you can even write them down. But in the heat of the moment, when the chart is moving and money is on the line, your brain starts to play tricks on you. Fear and greed take over. You hesitate to enter. You move your stop. You revenge trade after a loss. You double down when you shouldn't. And all of these behaviors come from one place: your inability to stay disciplined under pressure. Why does this happen? It happens because trading is not natural to the human brain. Evolution trained us to avoid pain and seek pleasure. We're wired to run from losses and chase wins. But markets don't reward that wiring. In fact, they punish it. To succeed, you have to rewire your responses. You have to learn to love small losses as the cost of doing business, and to distrust big wins as potential traps. One of the most dangerous traps is overconfidence. You have a few good trades, your account grows, and suddenly you feel invincible. You increase your size, loosen your rules, and before you know it, one bad trade wipes out weeks of progress. Overconfidence kills traders faster than fear. The key is humility. Every trade is just one trade. No setup is guaranteed, and the market doesn't care about your feelings. But let's flip it. Fear can be just as destructive. You've been burned before, so now you hesitate. You cut winners too early. You second-guess yourself. You sit on the sidelines while opportunities pass by. This is the psychology of loss aversion. Studies show that losing feels about twice as painful as winning feels good. That imbalance is why traders sabotage themselves. To overcome it, you need rules. You need structure. And most of all, you need to accept that losses are not failures. They are part of the game. Here's a key mindset shift. Your job is not to make money on every trade. Your job is to execute your edge consistently. Money is the outcome of that process, not the process itself. When you focus on process, you free yourself from the emotional roller coaster of wins and losses. When you focus on outcome, you get trapped in emotional swings that destroy consistency. Let's dig deeper into discipline. Discipline is not about willpower. If you rely on willpower, you will fail. Why? Because willpower is finite. It weakens under stress. Real discipline comes from building systems that remove emotion from the equation. Use checklists, automate your risk, write down your rules, create accountability. The more decisions you can make before the trade, the fewer decisions you have to make in the heat of the moment. One powerful tool is journaling. Not the kind where you just write down entry and exit prices, but real journaling. How did you feel before the trade? What was your mindset? Did you follow your plan? Journaling turns your psychology into data. Over time, patterns emerge. Maybe you always break rules after 3 wins in a row. Maybe you always hesitate after a big loss. Once you see the patterns, you can start to fix them. Another tool is visualization. Professional athletes use it all the time. They imagine the game, the movements, the challenges. You can do the same in trading. Visualize yourself following your plan. Visualize yourself taking the stop without anger. Visualize yourself passing on a bad setup. By rehearsing discipline in your mind, you make it easier to execute in reality. Now let's address revenge trading. Every trader knows the feeling. You take a loss, and instead of stepping back, you jump straight into another trade to win it back. It feels rational in the moment. It feels like you're fixing the mistake. But what you're really doing is abandoning your edge and handing control to your emotions. Revenge trading is the fastest way to blow up. The cure is simple but hard. Walk away. Set a daily loss limit. When you hit it, stop trading. The market will be there tomorrow. Your job is to protect your capital and your mindset. Risk management also extends beyond individual trades. Think about portfolio risk. Are all your trades correlated? If you're long the S&P, the Nasdaq, and Apple, you're not diversified. You're just tripling your exposure. A single market event could hit all three. Smart risk management means thinking about the bigger picture, not just the next trade. Psychology also ties into environment. If you're trading tired, distracted, or emotional, your edge evaporates. Professional traders treat trading like a performance. They prepare, they control their environment. They know their state of mind is just as important as their strategy. Ask yourself, would you let a surgeon operate on you if they hadn't slept, were angry, and distracted? Of course not. So why would you put money at risk in the market under those conditions? Here's something few traders talk about: identity. Many traders tie their self-worth to their results. A winning day makes them feel good about themselves. A losing day makes them feel worthless. That's a dangerous cycle. To break it, you need to separate your identity from your performance. You are not your P&L. You are the operator of a process. Some days the process produces gains. Some days it produces losses. But the value is in the process, not in the outcome. Let's talk about patience. Patience is one of the hardest psychological skills in trading. Most traders are addicted to action. They want to be in the market. They feel like doing nothing is wasting time. But trading is a waiting game. You're waiting for your setup. You're waiting for your edge. And most of the time, the right move is to sit on your hands. Patience is a weapon. The less you trade, the more you make. If the trades you take are high quality, another psychological pitfall is comparison. With social media, it's easy to look at other traders and think you're behind. You see screenshots of big wins, accounts doubling, traders claiming easy success, and suddenly you feel pressure, and you want to catch up. You start forcing trades. You abandon your plan. Remember this: nobody posts their losses. Social media is a highlight reel, not reality. The only trader you should compare yourself to is the one you were yesterday. Now let's tie everything back together. Risk and psychology are not separate topics. They are one and the same. Risk defines the rules of the game. Psychology determines whether you follow them. You can have the best risk management plan in the world, but if you can't control your emotions, you won't follow it. And you can have the strongest mindset, but if your risk rules are flawed, discipline won't save you. Success requires both. Trading is not about predicting the future. It's about managing uncertainty. It's about staying in the game long enough for your edge to play out. It's about mastering yourself as much as mastering the market. When you respect risk and control your psychology, you give yourself the one thing most traders never achieve: longevity. Thanks for watching. Please like and subscribe.